Hello and welcome to Kalkine Conversations with me, Santa. Today we will be talking about the oil and gas sector that is rebounding from the pandemic lows. And to discuss the outlook and how our companies bracing themselves up for the post-pandemic era, today we have Mr. Majid Shafiq, who is the CEO of 𝐲3 plc with us. Now, 𝐲3 Energy is an energy company which is focused on development and production of high-return hydrocarbon fields and discoveries. So, without much ado, let's start with Kalkine Conversations with me, Samta, and Mr. Majid Shafiq, who is the CEO of 𝐲3 Energy. Welcome to the show, Mr. Shafiq.
Thank you, Samta. It's good to be here.
Well, Mr. Shafiq, to begin with, can you describe 𝐲3 and its recent history?
Yes, so 𝐲3 Energy is an exploration and production company. We are headquartered in London and we are listed on the AIM markets of the London Stock Exchange and the TSX in Toronto, so dual listed. We have assets in the UK and in Canada. In the UK, we have some licenses offshore in the UK sector of the North Sea, on which we have a couple of discoveries, one of which we discovered last year called the Serenity oil field, which we think might have up to 200 million barrels of stock tank oil in place. We also have a Liberator discovery on the license and a potentially very significant exploration prospect called the Minos High, which itself could have several hundred million barrels. Those assets need to be moved through appraisal and then through to development. And in Canada, last year, we identified Canada as a place where we could acquire production assets at really low cost. So, up until that point, we had the assets in the UK, which are non-producing at the moment. We're hoping to move those towards development, but we wanted to move very quickly to become a production company, and had looked at a number of basins around the world where we thought we could acquire production cheaply, and ended up choosing Canada for a whole host of reasons, which meant that we could acquire producing reserves and producing cash flow at really low values relative to other places in the world. So we decided that we wanted to enter the Canadian E&P market and did a couple of transactions last year, completed in Q4 of last year, and we acquired around about 9,000 barrels of oil equivalent per day, which is about 60% gas, and around about 50 million barrels of 2P reserves. We acquired those at 1 times next 12 months cash flow, so at really, really good metrics. And we paid around about 40% of the value of the producing reserves, and the assets came with lots of upside in terms of additional reserves and additional potential, and all of that was essentially free. So, at the moment we have around about 9,000 barrels a day of production in Canada, and our business plan that we developed last year was essentially to acquire reserves at low cost in the current market as it stood then and as it still currently stands, whereby it's much cheaper to buy reserves than to drill those reserves. And last year, as the oil price collapsed. Many companies in Canada were highly distressed because they'd borrowed too much, which meant that the equity markets were very difficult in Canada and difficult for those companies to raise finance, whereas we were able to raise finance in the London market to acquire those assets. That market, although the oil price has risen considerably since last year, there are still lots of opportunities in Canada to buy reserves at really low values. And we always knew that once the oil price increased, and we thought once it got to 60, 65, $70 a barrel, it would actually be cheaper to drill than buy. And what we're finding is that we're still able to find reserves in the M&A market cheaper than we're able to drill. However, having said that, there are lots of opportunities now within our portfolio that make economic sense to drill at the current prices, and that's what we're seeing. So, our business plan is still active, which is to buy reserves when we can at low cost. And we're now beginning to look at our own portfolio and identifying capital investment opportunities that we would like to make at current oil prices, which now make sense.
Speaking about the Canadian operations, the company has released a number of RNS over the last few weeks concerning its Canadian operations. So can you describe the significance of these, please?
Yeah, so as I was saying, what we've announced over the last several weeks is activity, both organic and inorganic. So activity within our portfolio in terms of low-cost activity to increase production, and also we've announced some small acquisitions which concern assets that are situated around our existing portfolio. So we now have in Canada a core area which is relatively concentrated in 4 areas which cover the Wapiti Formation, principally the Simonette, the Martin Hills, Clearwater acreage, and a number of properties in central Alberta. And what we've announced over the last several weeks is some investments that we've made to increase production from the existing portfolio. So an example of that is a well in Noel that we're bringing on stream, which should add about 500 BOE per day. We have made an acquisition in the Simonette area, which has increased our ownership of those assets from approximately half to virtually 100%. We have farmed into some drilling opportunities in the Clearwater area, and we most recently announced a couple of wells that we're going to drill in the Wapiti area, and announced an LOI to acquire some production in the Wapiti area. Now, collectively, that's a combination of low-cost acquisitions and low-cost capex, which collectively should increase our cash flow, our net operating income, by about 30% from where we previously projected it. So, it's increased it from about 34 to about $44 million expected for this year, and our production, the potential production adds are around about 1,300 BOE per day from that activity. And very importantly, in aggregate, if you look at the cost to us of that workover drilling activity and acquisition activity, it's being done at 1 times next 12 months cash flow, which was the same price metric that we were able to achieve when we acquired the assets in Canada last year for around about $33 million. That was done at 1 times cash flow. We never anticipated that we'd be able to continue to acquire or add production and reserves at those metrics, and we've been able to do that, which is obviously really good for us. So what those announcements have demonstrated is essentially the value of the portfolio we've acquired. It's a really large portfolio. There are lots of opportunities within it to extract additional value that the previous owners didn't have the capital to exploit, and also demonstrated the value of having a concentrated portfolio in terms of being able to add incrementally small reserve adds around the portfolio and within the portfolio through the acquisition market. So it's really demonstrated the validity of our business model and the value of our portfolio, and we foresee lots of additional opportunities beyond what we've announced over the last several weeks, because we've only operated the assets since last October, so around about 9 months, and the initial part of that period was focused on integrating that business into i3, integrating the assets that we acquired through 2 transactions into 1 business in Canada. And we've now begun to get to grips with the portfolio and have begun to identify value-adding opportunities within that portfolio, and there are lots more within that portfolio that we will look to exploit. And there are drilling opportunities. There's lots of drilling opportunities within the company, but there are also lower cost exploitation opportunities.
Talking about opportunities, what does the future hold for the company?
Well, so in Canada, it's more growth essentially, both organic and inorganic. When we entered the Canadian market, it was with a growth business model. So we're sitting around about 9,000. We think this recent activity will take us to 10,000 barrels a day this year. But we want to grow. We want to grow significantly beyond the 10,000 barrels a day and grow quickly. And there are two ways for us to do that, as I've explained. One is by exploiting opportunities within the portfolio, and the other is through acquiring. And we're very active on both fronts. So, what the market should expect from i3 is more growth. So through workovers within the existing portfolio, through drilling within the existing portfolio. There's also activity in terms of increasing recovery factors from existing producing fields, many of which are mature, and we've identified a number of fields where we can start or restart secondary recovery through water injection and water floods for pressure support and water flood for additional recovery. Hopefully, we'll be executing on some of those projects and announcing them as we do so. But also, as I said, we anticipated that at this oil price, it would become more difficult to acquire on the metrics that we'd acquired at. And we're finding that there are still lots of really good opportunities within the market to acquire at 1x cash flow. And, we would be willing to acquire at higher multiples than that. But we have within the portfolio over 450 drilling locations that have been worked up, over 250 of which have rate of returns of greater than 30%. Those drilling opportunities now begin to look attractive at these oil prices. And so any acquisitions we might look at have to compete against the opportunities within the portfolio for capital allocation. But it's a really nice problem to have, obviously, to have a very large portfolio and have the option to invest in acquisitions when it's better to do that, or as oil prices increase, we've acquired all these opportunities and all these upside opportunities and not have had to pay for them, and we will exploit those through the drill bit in a higher oil price environment in which we currently sit, and hopefully will continue to sit for quite a while. In the UK, we're hoping to announce that we have found joint venture partners to help us appraise our UK assets, which have very significant potential value in Serenity and Liberator and the Minos High prospect. And we're hoping to announce farm outs of that acreage so that we can use that as a means of financing appraisal drilling initially on the Serenity oil field, which, as I said earlier, we think could have 200 million barrels in place. And what we need to do is drill appraisal wells to confirm that. If it is that order of size or even smaller, it will be a very significant asset in terms of value for the company. So yeah, that's hopefully what the near-term future will hold for i3. Lots of activity both in Canada and hopefully in the UK.
Well, the future certainly looks promising for i3 Energy in both UK and Canada especially. Can you share with our listeners, why should an investor invest in i3? Okay,
well, firstly, we believe we're very undervalued compared to our peers, particularly our peers in Canada who trade on higher multiples relative to their cash flow. And I believe that through the demonstration of accretive activity that we've begun to show with these announcements we've made over the last few weeks, and hopefully additional announcements we'll make in the near future, and also as we commence paying a dividend, which we hope to do in July, that our price will re-rate and we will be fairly valued compared to our peers. And our brokers, our corporate brokers in the UK, have target prices of up to 25p per share. We're trading around about 10p a share. So we think we're very undervalued and think this is a very good entry point for new investors. And with all the anticipated activity, there's potential for significant share price growth from here. We have lots of blue sky upside in Canada, in the as we've mentioned, in the Clearwater Formation, Simonette, and other formations. and low-cost activity similar to what we've recently announced. So there's lots of potential there. And also in the UK, you know, Serenity, as I mentioned earlier, is a really significant asset. If it's as big as we think it is, it's going to add multiple barrels of reserves to the company. And that asset, if it were to be developed and that big, obviously is worth several $100 million. So there's potential for really significant share price growth, and with all the potential news flow, all the potential activity, we're hoping there will be a regular news flow, as we're now starting to demonstrate, and multiple value catalysts for that share price growth. And so, you know, so there's potential for share price growth, but also we will, after we've paid the dividend, be a dividend paying company. And so we have, you know, the ability to return significant value to shareholders, a cash return through dividends, and we're hoping to make that first payment in July as a special dividend, and then get into regular half-yearly dividends, which, you know, will be paid after our half-yearly accounts are published and after our annual accounts are published, and hopefully we'll get into that cycle this year. And you know, our target is to pay up to 30% of free cash flow out as dividends to our shareholders, you know, and currently where we're trading, that corresponds to a really significant yield compared to our peers. So, you know, we have the potential to return value to existing shareholders and new investors through share price growth and cash return through dividends. So lots of reasons, I think.
Thank you, Mr. Shafiq, for your time and sharing your insights with our listeners today on i3 Energy and its plans, and i3 being the perfect opportunity for potential investors.
Thank you, Samantha.
To know more about i3 Energy, you can visit their website, that is i3.energy. And to listen to this podcast again, please log on to our website, that is kalkinemedia.com, or you could also subscribe to our YouTube channel. Till we see you next with yet another insightful episode of Kalkine Conversations, this is me, Santa, saying goodbye and take care of yourself. And like we always say, stay apprised and invest wise with Kalkine.